I think that the major providers of ETFs and the companies that are doing this, like BlackRock, I mean, it's a great firm. They run that business very well.
And we're always looking for the next problem.
You know, always looking for the next problem. Vanguard, great firm. They run that place very well. Very client-friendly, Vanguard. So I think that ETFs, the growth has been massive. It can't continue at this pace, but it's clearly a very important part of an investing portfolio for retail investors, financial advisors. Huge growth in ETF usage by financial advisors at Morgan Stanley, Merrill, and across the street on behalf of their clients.
What happens if Dodd-Frank gets repealed?
You know, I think we were talking about this, Kelly was talking about financials rallying yesterday. I think some of it was around the potential repeal or rollback of specific pieces of legislation like that.
Would you be happy
Michelle?
about that?
I think there are, you know, Stan was saying this earlier, there are aspects of a lot of this regulation that can be reworked and fine-tuned.
You can't just say yes?
I think, no, because, I mean, there's a lot in there.
Money was spent to comply with it in the first place.
Well, that's actually the whole regulatory umbrella notion. One of the reasons the market's rallying is because if you're peeling back a lot of regulation, it's good for business. But a bigger positive impact on the banks yesterday was the notion that maybe capital standards will get peeled back. I mean, there was some dialogue around that. Maybe the capital ratios that have been put in place, that even they could be eased.
Volcker rule?
You know, same thing. I think there are aspects of that while it might have tried to target something that was a specific problem during the crisis, that overreached. So I think, look, the regulatory framework coming out of something like the credit crisis clearly is going to be comprehensive. There's going to be a lot that the government puts in place as a result of popular backlash. And then what happens, you know, typically, and this is true historically, 8 or 12 years later, there's a move to start to look at it again and rework it and peel it back. And that's one of the reasons why the market is as upbeat as it is right now.
We've already been in a bull market for 8 years. You asked Dan Druckenmiller about the length of the bull market, whether it can keep going, whether the policies that have been put out are basically enough to stave off a recession. Do you believe that they are, what you've seen?
Yeah, well, look, you know, I think there's a tension here. And certainly Mr. Trump and his advisors have been quick to point out pro-growth policies, stimulation on the fiscal side, tax cuts, the whole notion of repatriating a lot of this money from corporations back to the U.S., maybe doing it on a preferred basis. Stan said a tax rate, a one-time tax rate of potentially less than 10%. That's all positive. I believe that we're doing that against the backdrop of a later cycle economy where rates, which should have been going up sooner, are now finally going to go up. And as Stan said, those two things are going to run against each other. So you might have had growth, in Stan's words, of 4% or more from the positive policies around fiscal stimulation, tax cuts, repatriating capital. And on the other side of the equation, you've got higher rates and a later stage economy. Whatever you think of the growth, Joe, it's year 7, 8 in an economic cycle with an underlying business.
But nice if your rates absolutely soar and you end up at 4%. I mean,
if
that seems long-term like a pretty good number.
For that reason. But one of the problems with where we are is that, in my eyes, and Stan echoed this, the Fed has been late, and the rate cycle is late.
Right.
So when you start moving on rates, and as Stan said, and I believe this, the bond market yesterday said we're going on our own. We're not waiting for the Fed. This is what we think is happening.